In trading, the most important factor that decides whether you can become a profitable trader is risk-to-reward ratio. If you maintain a proper risk-to-reward ratio while trading, you can become a consistently profitable trader. To understand this clearly, today we will discuss 3 types of risk-to-reward ratios, and at the end, we will also cover the 5 most important points you must remember. Risk-to-reward example, 1-to-1. If you carefully observe this chart, you can see that price formed a support zone on the lower side. After a short consolidation, price broke above this zone with a strong bullish candle. Because of this move, a long trade setup is created on the buying side. Some new traders, after the close of this hammer candle, consider the resistance line as their profit target and place their stop loss below the lower support line. They then enter the trade. In this setup, the number of points for the target is equal to the number of points for the stop loss. This type of setup is known as a 1-to-1 risk-to-reward trade. This category of risk-to-reward ratio is generally not considered ideal. To become profitable using this risk-to-reward structure, your trading accuracy must be above 50%. That means if you take 10 trades in a day, at least 5 trades must be profitable. Otherwise, by the end of the day, you will not be in profit. If you continue trading with this approach, you will remain in losses, and on top of that, brokerage and transaction costs will have to be paid from your own pocket. That's why, if you are trading highly volatile instruments like Forex pairs or gold, you should avoid 1-to-1 risk-to-reward trades. This setup involves higher costs because you take many small trades, and frequent entries increase losses instead of profits. This kind of trading also leads to overtrading, which negatively impacts your trading psychology. Unless you are a highly experienced trader, you should avoid this setup. In any trading format, 1-to-1 is considered one of the weakest risk-to-reward structures. Risk-to-reward example 2. 1-to-2. Now let's understand the 1-to-2 risk-to-reward ratio. On this chart, price breaks out of a small consolidation area, forms a new swing high, and then pulls back toward the same zone. Near this area, price forms a bullish engulfing pattern, creating a strong reversal setup. Here, you can plan a long trade by placing your stop loss below the support zone and targeting the previous swing high. In this setup, the target is twice the size of the stop loss, which makes it a 1-to-2 risk-to-reward trade. To become profitable with this structure, your trading accuracy needs to be around 33%. That means out of 10 trades, you only need 3 to 4 trades to hit their profit targets. If you are a day trader or a scalper in the Forex market, this setup can be one of the most profitable for you. By following this structure, even if you take 10 trades in a session and strictly follow your stop loss and target rules, you can still remain profitable with only a few winning trades. Even if only a few of your trades hit the profit target, you can still become a profitable trader. This risk-to-reward setup can be used during trading on any time frame. But in this setup, you must learn to control your emotions, because the market will never hit your profit target in a straight line. After your trade entry, price will sometimes move up and sometimes move down to create fear. At that time, you must strictly stick to your stop loss level. Only then will you be able to use this setup correctly. Now let's understand the 1-to-3 risk-to-reward ratio. During intraday trading, setups like this are found very rarely. You can successfully trade a 1-to-3 risk-to-reward setup only when the market is trending. Because in this setup, the profit target is 3 times bigger than the stop loss. Even if your trading accuracy is only 25%, you can still make profits. For traders who do swing trading, this is one of the best setups. If you are new to the market and find it difficult to control your emotions, you can use a trailing stop loss, book partial profits, and keep a portion of your position for a bigger target. This will make it easier for you to hold the trade. Important trading rules. Point 1. If you trade on lower time frames, such as very short-term charts, then a 1 to 2 risk-to-reward ratio works best. If such a setup is not present on the chart, you should avoid taking a trade. Point 2. If you are a swing trader, use either a 1 to 2 or 1 to 3 risk-to-reward ratio. Point 3. Before entering any trade, first calculate how much stop loss you are planning to use. Only enter the trade if the profit target is larger than the stop loss. Point 4. Always place your stop loss directly in the system instead of just keeping it in mind, and follow it strictly. Point 5. In one trading session, take a maximum of 3 to 4 trades. If your stop loss gets hit 3 times in a row, stop trading for that day. Don't forget to subscribe to the channel. Thank you.